MaRS Best Practices focuses on providing really actionable tips for entrepreneurs. It's a bit of a deep dive, a bit more than our Entrepreneurship 101 series. And today, our event is on demystifying SRED and other tax tips for entrepreneurs. SRED meaning scientific research and experimental development. And it is in partnership with Welch LLP, which is an accounting firm and a service provider here at MaRS. They have been working with us for quite some time and have been very, very generous in giving their time to our entrepreneurs and to some of our programs. I know they're working with our Entrepreneurs Toolkit in building out some resources for the entrepreneurs that are working with us. So we're very glad to have them, and I'll just introduce them very quickly. We have Bryan and Terry. Bryan is a partner at Welch LLP, and Terry is the Director of Business Incentives. Bryan has more than 20 years of experience in public accounting, and he specializes in providing financial services to entrepreneurs from private and public companies, including charities, government departments, and agencies. In his role as a partner at Welch LLP, he provides a range of assurance services, technical accounting services, advice, income tax planning and compliance, and financial statements and internal control advisory services. Terry leads Welch LLP's business incentives practice, a field in which he has been working for more than 10 years. Through his practice, Terry helps companies of all sizes and in various industries across Canada to access government incentives such as tax credits, grants, and rebates. Before joining Welch, he was a national leader for government incentives for Ernst & Young LLP. And in addition, he spent approximately 8 years at Nortel Networks in various software development, architecture, and network and business planning roles. They've also, I mentioned their generosity before, they are also spending time after this presentation to meet one-on-one for about 30 minutes each with different companies. Some of you would have signed up. We do have room for a few walk-ins between 4 and 5, so if you haven't signed up and you would like to sign up to sit with them and just have a chat with them and ask some questions specific to your business, you do have room to do that. I will have the sign-up sheet, so you can sign up after. If you have questions during the session, they're very, in terms of engagement, we do have one mic there. I will have the other mic, so just put your hand up, please, or go directly to the mic that's there. Thank you.
Great. Maybe what I would like to do is just kick off the discussion and do a quick tour of the room. And Gina, maybe you can start at a table. And very quickly, would like to know, do you have a business? And what are your objectives from a session? So, maybe 20 seconds, just so Terry and I can gauge that what we're going to talk about lines up with sort of where your interests lie. So maybe Gina, if you could pass the mic around, we can just do a quick roundtable around the room. Introduce yourself. Do you have a business, and what's your objective for being here?
Starting up a business in exercise equipment. And my objective is to learn mainly how to use SREDs when you don't have revenue.
Okay. Thank you.
Kevin Albrecht. We've been up and running for about 2.5 years now, so we've gone through 2 SRED processes, and basically want to hear about other people's experiences and consultants for SRED, what percentages people are paying, and what we should expect from a SRED consultant.
Okay.
Mohammed Badra, Buzz Home. We are already in business for about 4 or 5 years now. I've just recently joined the company and would like to introduce them to the SRED programs and how we can benefit from that.
Okay.
Shlomit Königsberg. I'm currently working for a private research institute, and we are doing SRED for the last 2 or 3 years, and it's a very tedious process, and I'm about to have my own company, so I would like to know more about SRED.
Okay.
Hi, I'm Veronica. I have a new business for connecting people in the dance community, and I'm just wondering if I can get SRED credits for the website development.
Okay.
I'm Deb Flanagan. I run Lennox Elder Care Consulting, and we're looking for a platform build and software applications to develop, and how we might get some money for that.
Okay.
Hi, I'm Mary Chong. I'm from Ravello Bikes, a startup of about 2 years now. And we've invented a lightweight compact electric bike for urban commuters, and we'll continue to go on to develop new SKUs as well. So I know all incentives.
Hi, I'm Sahar Hairi. I'm part of a clean tech startup line of MaRS, hydro-based. We are working on development of a clean technology to convert low-grade heat to electricity, and we're doing a lot of R&D with a university partner, so we'll be very interested in this.
Hi, my name is Fayad, and I work at a media startup, so we're just launching in a few months, and just want to learn more about SRED. We don't know anything about it.
Okay.
Hi, my name is Mark Stone. I'm background as a physician, and looking at the startup space, so just here for general interest.
Hi, I'm Natalie. I work for a small startup tech firm. We launched our application last year, and we're just in the process of applying for SRED, so just wanted to find out more information on the overall process.
Hi, I'm Jen. I run a makerspace for kids. We teach kids 3D printing and that type of thing. And I want to find out how we can get money for hiring people and also how we can do everything right from a tax perspective.
Okay.
My name is Kareem. I run a tech firm, about a year old. We just got our first SRED claim approved, so I just wanted to know more going forward, what else I can claim.
Okay.
My name's Greg. I have a web application that's used in the sport industry. I've not yet applied for SRED, but something I'm looking to do.
Okay.
Hi, I'm Daniel. We're in medical software. We did our first SRED claim, but we ticked off that we were doing technical development instead of pediatric development. And so I'm just trying to understand a little bit, and we got audited. And so I want to know a little bit more going forward about specific ones that are not technical development, how you can do a SRED application for that as well.
Hi, my name is Fraser. I work in agriculture, and I wanted to know whether we were eligible for SRED credits.
Okay.
I'm Kathy Steffen. I work with Bryan and Terry, so I'm just here to watch, and if there's any questions.
Mike Papanicolaou. We do work with Sunnybrook, and we've done some in-kind work, and we want to know how to properly apply for the SRED credits towards that.
Hi, I'm David Kendall. I'm a technical co-founder in a couple of startups. I just want to make sure we do development right so that it's SRED eligible.
Okay.
Hi, I'm Danny Morrell here with my partner Wanda. We run a staffing agency, and we're just here to gain general information. We're open minds. Don't know much about the process, but something we can learn.
Hi, and I'm Wanda, and we're just here to get some general tax tips for entrepreneurs.
Hi, I'm Chris. I have my own bookkeeping business and a number of clients in the MaRS building. So I just want to hear more about some of the changes to the SRED program and how it might affect my clients.
Hi, I'm Albert. I have my own app development business. I just want to find out about SRED and also the Ontario Digital Tax Credit.
Okay.
Hi, my name's Jonathan. I'm an app developer, and I'm also moving into 3D printing. I just want to see if I qualify for some of these tax deductions.
Hi, I'm Monique. I'm just interested in understanding some of the taxation issues for startups. Very, very basic.
Okay, great. So there's a common theme here. A lot of you are keen to understand the SRED filing, accessibility of SRED. And so Terry will to deal with the SRED program and other business incentives at the second half of the session. The first half we'll talk about tax compliance. And it's not applicable for all incentives, but for the SRED claim in particular, and for the Ontario Digital Media Credit. In order to get it, you have to be compliant with your tax filings. If you're not compliant with your tax filings, it doesn't matter how eligible you are and how sizable your claim is, CRA won't, the Canada Revenue Agency won't process it, and if they won't process it, you won't get your money. And so we'll talk about the compliance requirements first, to sort of set the stage, and then Terry will get into a business incentive discussion. It's unlikely he'll get into enough detail for you to walk away knowing definitively whether your activities are eligible or not, but it'll give you enough to start thinking more about it, and either do more research or consider engaging someone in a more detailed conversation. Okay, so great, thanks for doing that. So I'm Bryan, by the way, in case you're wondering. So we'll talk generally about income tax compliance and tax considerations that are relevant just overall as entrepreneurs, but it will dovetail into the discussion that Terry will have around business incentives. So this is the agenda. So the first half is really tax compliance, and then Terry will deal with the second half, business incentives. As Gina indicated, love this to be interactive. So we've got a mic there, and there's another mic in Gina's hand. We've got an hour set aside for us to talk about the content, and it's very technical in nature, and Terry and I can ramble on for quite some time because with what we do day to day in our business lives as it relates to this topic and helping clients deal with it. But we tend to get more out of it and feel like we're actually helping you if this is interactive. And so as we go through it, if you've got questions, I encourage you to ask questions. We will have some time at the back end for a Q&A. But if you know, we can certainly make this interactive as well. Already a question, look at that.
Just a quick question, if this will be available, if your presentation will be available.
Yes, I believe it's going to be online. We're videotaping it, and the slides will be available. Yeah, yeah. So encourage you to ask questions and engage in the dialogue. We've got a sort of hard stop around 1:40. Then Terry and I need to sort of prepare for a 2 o'clock meeting. So that's sort of the time commitment we have. Okay. So just generally, what are your filing requirements? So first off, you have to you need to determine what's the structure of your business. Is it a partnership, sole proprietorship, or a corporation? So if it's a corporation, if you incorporate your business right out of the gate, you're on Revenue Canada's radar screen. You have an obligation to file a corporate tax return. And so what this tells you is, what are the requirements? So prime example, December year end. You've got 6 months to get that corporate tax return into the hands of CRA. If you don't, it's considered late and subject to penalties. If there's no taxable income and no tax owing, those penalties and interest would be negligible. But if you're late, CRA will withhold HST. So if you've got HST receivables and you're not compliant on your corporate tax filings, it could impact other compliance requirements and access to other capital. And so it's really key to make sure you stay on top of your, if you're incorporating a business, to get that corporate tax return prepared and filed on time. If you do have taxable income, so revenue less expenses, taxable income, you then do have a tax obligation, a liability to pay to Revenue Canada, and that tax is due either 3 or 2 months after your year end. So again, if you're a December year end and you had taxable income less than $500,000, that's the defining point which determines when the payment's due. If it's less than 500, it's due at the end of March. And if it's not paid within that 3-month period, then it's subject to interest. If the tax return is filed late beyond 6 months, then on top of interest, penalties will be levied by CRA. And so obviously something you want to avoid. After your first year of filing and first year of taxable income, CRA will request installment payments. And so and those installment payments are imposed on the corporate entity. If you just incorporated and you're trying to decide, what's my year end, you have full discretion. The corporate entity can have whatever year end it wants. But from the date of incorporation, you have 53 weeks to sort of draw that line in the sand. You've got to make a determination within 53 weeks. So if you incorporate Feb 1st, you have until Jan 31st. So 53 weeks to determine your year end. You can change your year end. Once you've set it, you can change it. You can't change it after the fact. You only can change it in the year of, and there has to be a business reason to it. So what CRA doesn't want you to do is constantly change your ends to manipulate your tax obligations, access to SRED, and other tax items. If you've incorporated a business and you've got employees, you also have payroll remittances, EI, CPP, and you have to withhold taxes. And those are due the 15th of the month following the payment of the taxes. You obviously then have T4 requirements. Those are due 2 months after your year end, or actually 2 months after the calendar year, because employment income, doesn't matter what your year end, employment income is taxed on a calendar basis, and the corporation has an obligation to create those T4s and have them prepared and issued to the employees by Feb 28th. You also, when you incorporate, You'll likely register for HST because my presumption is you've got either taxable sales or you're incurring expenses that are subject to HST, and so you'd want to register and prepare that HST return. There are different filing dates. So the bigger the business, the more frequent the HST filings are. For new businesses, typically it's annual, and the HST return is due 3 months after the year end. We haven't talked, as it relates to other corporate structures, proprietorships, partnerships, they're really effectively treated from a tax perspective similar to yourself. So if you have a proprietorship, the income of the business is filed as part of your personal tax return, which is due on a calendar year basis, and the obligation is payable by April 30th. If it's a partnership, the income or operating activities of that partnership will flow into your personal tax return. The partnership does have a tax reporting requirement. It's called the T5013. So the partnership itself has to have separate statements. Those separate statements then determine the allocation of the income or losses to the individual partners. It's reported on a T5013. That document then flows into your personal tax return and gets taxed or tax affected as part of your personal tax filing. Any questions on that? A lot of content, but it's really just compliance information. Yes?
Just the last one, so if it's only your company?
So you've not incorporated?
If you're incorporated and you're the only shareholder, you don't need to worry about the last one, or you do?
Well, if you've incorporated, the corporation is, for tax purposes, is a separate legal entity. So it's distinct and different from you as a person. But a sole proprietorship and a partnership is not separate and distinct from you as a person as it relates to income tax. So if you've incorporated, all the earlier stuff I've talked about, you need to deal with. You need to file a separate corporate tax return. And as it relates, how the corporation and you interact, whether the corporation pays you a dividend or whether the corporation pays you salary, that'll impact on your personal tax filing.
Okay. Thanks.
Yeah, no problem.
If you incorporated, but like you don't actually file your personal tax return, does that affect your SRED? Because if you're not making any income and you just don't bother.
Ask me the question again, please.
If you don't file your personal tax return because you're not making any income, so you just don't bother,
Right.
it won't affect like the corporation or the SRED?
It shouldn't.
Okay.
But I encourage you to be compliant. If you've got no income to declare, then filing of your personal tax return should be quite a routine exercise.
Okay.
And I would encourage you to do it. So what we're going to talk a little bit about now is about the tax rates. And these are important because it determines what your tax liability will be. And the presumption here is that you have income. So what I'm going to contrast is what the personal tax rates are versus the corporate tax rates. And it's important to know because if you have a business and you've incorporated, these tax rates are important when you think about where income is earned and how it's distributed. Because the tax rates are different and they could result in significant differences in your tax liability. And so these will drive planning that entrepreneurs should be contemplating when they think about the business as incorporated and the individual entrepreneur. And so from a personal tax perspective, the tax rates are on a graduated tax basis, which means they go up. The tax rates increase in steps. And this really tells you, for the first $43,000, you're paying personal tax at the low rate. As your income increases, and these are federal rates. I'll show you the combined rates in a second. This just shows you that as your personal income increases, the taxation that applies in those bands also increases. From a combined perspective, if you look at Ontario, salary and interest, on a combined provincial and federal perspective, this is at the top marginal rate. So when I talk about top marginal rate, I'm talking about the fourth bracket. If you've got income in 2013, personally in excess of 135, you'll pay tax at every dollar above that at the top marginal rate at 46.4%. What you'll see here is we've also provided the tax rates for income other than salary and interest, so you can start to see what the impact is. So if you had two choices to get salary or dividends, your clear preference would be to get dividends, because dividends are taxed either at Ontario 32% or 29%. So pretty significant difference between getting income at a salary level. Now you never make decisions just because of the tax rates, because as Terry will talk about later, salary versus dividends also impact your SRED claim. So all of this data forms part of how you make decisions as entrepreneurs around how money's spent and where it's spent and how you pay yourself.
Sorry, I noticed that you have 2 entries for Ontario, one with a note next to it. Do you know what the difference is there?
Yeah, I can't recall what that is. That might be the Ontario. Ontario has an additional surtax on income above $500,000. So that's probably what that note talks about. Yeah. So contrasting this is the corporate tax rates. So what's important to know is that if you've got, so as we just saw, income above $135,000 is taxed at 46%, and if it's above 500, it's at 49% in Ontario. The corporate entity, if that income is sitting in the corporation, the first $500,000, so if it's $500,000 or less, the combined tax rate, and so we'll have to, maybe what I'll do is, I don't have a pointer on here. Do I have a pointer? Oh yeah, there you go. So income less than $500,000 in the corporation, in Ontario, combined provincial, federal rate is 15.5%. So if the income sits in the corporation, you're paying 15.5%. Versus if all that money came to you personally, you're paying in excess of 46%. So again, this is here to illustrate that you need to be thoughtful about where the income is and how it's distributed. Now, and the other thing, and we'll talk about it later, but so it'll be taxed at the corporation at 15.5% if it's under $500,000. Every dollar above $500,000 then gets taxed at the higher corporate rate at 26.5%. If that's all that happens, if all the income just stays in the corporation, then there's no further tax to pay. The additional tax is levied when the income moves from the corporation to the investors or the entrepreneurs who are the founders. And then that's when you make a decision of, do I pay out the income from the corporation versus salaries, which ultimately reduces this income, or do I get it taxed in the corporation at this low rate and then decide to pay a dividend and then subject myself to the dividend tax rates, which are either 32% or 29%. So this is where the math starts to come into play, and this is where some planning. For young companies, it's not that critical, but it's important to understand these as the business starts to get established, and you start thinking about some of the ways to minimize the total tax burden of the business and you personally. So really, this is just arming you with information, and we'll talk about a little bit later some of the tax planning opportunities. Okay?
Quick question.
I think you should. You need the mic because it's being taped, so we have to. Otherwise, we don't get the question.
Can you give an example of what an eligible dividend is versus a non-eligible
Sure.
dividend?
Eligible dividends are taxed at a lower rate because they're paid they're paid from income taxed. So we've got 2 corporate tax rates, one for income less than 500 and one for income that's above 500. Okay. And so if you pay a dividend, so if all of the income is taxed at 500 and it's paid this low rate of tax, and you've paid a dividend on any residual, it's called a non-eligible dividend, and it's taxed at the higher rate because effectively you've paid less corporate tax. The taxation system in Canada has this concept of integration. They want to integrate what the combined tax rate would be so that you as a shareholder don't have an incentive one way or the other. But these rates do actually drive incentive because there are major timing differences as to when the amount gets taxed and who gets taxed to. And so the eligible dividend versus non-eligible, eligible is for dividends paid on amounts taxed at the high rate.
Okay.
Non-eligible at the low rate.
Thank you.
Okay, you need a mic. Or you can go there, yeah.
Is there a limit as to how frequently you can pay dividends?
No, but it has to be the payment of dividends has to be a corporate resolution approved by the shareholders, and you can pay them as frequently as you like. I'm not sure why you would, though. I think from a corporate tax planning perspective, we tell lots of our entrepreneurs who are debating salary versus dividends, there's no requirement for you to make a decision month to month. So what we often advise our entrepreneurs is pay yourself in advance, and then then ultimately at year end or at some point in the year, you can determine is that advance salary or is it dividends? So you have certain flexibility. That flexibility would be lost if you have a fixed employment agreement and it defines that your, what your employment income is. Then CRA may look at that and say, well, you're delinquent on your filings. But many times entrepreneurs, when, particularly if in the early days, don't have employment agreements, they're bootstrapping their businesses, they're pulling money out of the business, and so there's some flexibility as to when you need to make the determination. And so pull the money out, pull it out as an advance, and then determine is it best as salary or best as dividends. And that, what'll factor in there is SRED eligibility, net tax costs, those kind of things. Okay, you need a microphone.
So if you have an early stage business and you want to actually have a salary, what I'm wondering is what happens in the case where then suddenly, for unforeseen reasons, you don't have enough cash in the business to pay your salary? Can you adjust the salary or just defer it?
Yeah, you can defer it. Yep,
payable,
absolutely.
that sort
Yep.
of thing?
Yeah, that's right. Yeah,
But you can't
many
really change
will
it.
do that.
Okay, but for tax purposes for the corporation, you kind of have to stick with that.
No, you can, if you've got an employment agreement and the company just doesn't have to, then you as the employee can agree,
To take less.
Yeah, to defer the payment of that salary. Yeah, and then it becomes an obligation of the business. And then again, at some point, you can decide if that obligation isn't realizable, then you can decide to write it off again. But oftentimes it gets more complicated because it's not, if it's not just you and there's other founders involved or there's investors, you need to make sure everyone's on the same page. There's a question back there.
So going back to your question about paying in advance and then determining whether it's salary or dividend later, if you go later determine it as salary, then are you technically non-compliant on the CPP and the EI contribution?
No, I think that strategy works well initially, but once you've and so there's no, so you can do a cumulative adjustment, register for, because when you start paying a salary, if you have no other employees, you have not yet registered to remit the employee benefits. But once your first employees comes on board, you now have an obligation and you will have to register to remit EI and CPP and taxes withheld. As it relates to you as the entrepreneur, I think you'll always have flexibility, but if you decide it's a salary, then that's automatically going to trigger the payment of CPP. EI is dependent on how much you own of the business. If you own more than 40%, then you're not required to remit EI. You may still have to withhold taxes, and all that would be due. So let's just say you decide in December to pay yourself a salary to cover off some of the amounts that you've advanced throughout the year, then those payroll benefits would be due January 15th.
Okay, so basically that only works if you don't have a payroll account. Right?
Well, if you don't have a payroll account and you want to pay yourself a salary, then you now have to. It'll trigger a requirement to register. Okay? So I mean, I think this is very straightforward, but we do get surprised when we meet entrepreneurs and they haven't done this. And this is tracking their business activities and delineating the business activities from the personal activities. We recognize that the two can cross over, and so that business costs incurred personally can be incurred on behalf of the business, but then you have to have a mechanism to move those costs into the business. But fundamental in filing any of your corporate tax returns, HST returns, your payroll remittances is that you are tracking the activities, the financial activities of the business. And cash-based accounting is not acceptable. The income tax rules require it to be on an approved basis of accounting, which in the concept is accrual basis. So you may have sold a service, but even though you haven't got paid, it's taxable. So that's a prime example of a difference between cash versus accrual. So if you're in the business of selling products and you've sold them and the title is transferred and you haven't got paid yet, just because you haven't got paid doesn't mean it's not taxable income. So it would be income. So you need to track your financial results on an accrual basis of accounting. We've got a bookkeeper in the room, and he'll know that very well, in order to be able to have the information to prepare your tax returns. The same happens for HST. If it's a taxable supply and you've sold it and it's a receivable, but you haven't got paid yet, CRA still wants their money. So you still have that HST you've collected, you have to remit it. Yes?
Can you talk about Deferred salary, you mentioned deferring salaries.
Yeah.
What's the taxable situation there?
Well, if you've deferred it and haven't reported it, then it's not an expense of the business, nor is it taxable. So really, this slide is really just talking about maintaining good financial information to be able to, well, first off, run your business, but two, make sure you can complete the tax compliance requirements as they're required and accurately. It's one thing to complete the information, but if it's not done accurately, then you're effectively just creating a make-work project for yourself that you'll regret. And we've seen it. We tell entrepreneurs, keep on top of the stuff. Time and time again, they get focused on the business. I get it. And they think the compliance stuff they can take care of and they'll get it right sometime later. Well, that sometime later never happens at a good time. It always becomes a major distraction and a major burden. It becomes very expensive at that point to get it right. And it typically happens when there's pressure, a sale happening, cash crunch, a new investor coming in. So it never happens at a good time. So my advice is keep good, accurate, up-to-date financial information and stay compliant with your tax requirements. And then it will be easy. There will be a cost, but the cost will be less than ignoring it and then trying to do a catch-up. Lots of good software out there. I don't need to get into it, but it's not expensive. This is here not, and what I don't want to leave you with the idea that you should be doing your own accounting. What I always tell people is you have an expertise. I have an expertise in accounting and income tax, so I could do my own books. Entrepreneurs, what I tell them is maybe early on, track your financial information, track it on a spreadsheet, but there'll be a point where the pain and it becomes too great, where you're up at night worrying about whether you've got the information accurate, that you'll need to hire a bookkeeper. It's an inexpensive cost, but it is a cost of doing business. And they'll worry about the software. And there's all kinds of stuff that you can access remotely through your handheld. There's all kinds of beautiful tools out there. But leverage the experts to help you get it set up and track it. So this is talked a little bit about this. For entrepreneurs, there is this blurring because they're incurring costs. They're incurring costs personally on their personal visas, or they're just paying for expenses personally. And then they often wonder, well, are those expenses that are they personal or business? So the general rule is, if you're incurring a cost personally that relates to the activities of the business that should help drive business income, then those personal expenses should be deductible by the corporation. And so how do you move it from you personally to the corporation? An expense report, some sort of form of reimbursement, provide the corporation with the supporting documentation, and then just reflect those transactions in the business. And then the business ultimately owes you, as the entrepreneur, the funds that you've incurred personally. And so that general rule, I think, is, we can get into all kinds of details around what's eligible, what's not eligible, home office, travel, meals and entertainment. There's a whole laundry list of things. But if you keep that basic rule in mind, you'll be, I think, well served. And then you just, when it comes time to preparing your financial information, that's when you leverage the bookkeeper or your tax advisor to confirm the eligibility and deductibility of certain expenses.
Can you defer those expenses? So if you're going to charge it to the company and the company doesn't have funds at that time,
Absolutely.
Can you defer it?
Absolutely.
And how long can you defer it for?
There's no defined period.
So you could potentially accumulate these costs over like a 10-year period and then just get paid out?
Yeah, when companies are being bootstrapped, the entrepreneurs are oftentimes funding the activities to their personal amounts. And so oftentimes that cash is going in as an advance. So the business owes you, the entrepreneur. And again, one of the things that I always advise my clients is, incorporate the company with nominal consideration. And if you're funding the business with your personal cash or incurring costs personally, don't characterize that as share capital. Characterize it as a loan that you're making to the business, because it's the most straightforward way to get it back out of the business. Because as an example, a mistake that some people make sometimes, and it depends on the circumstances, but they'll advance money and they'll put it in the as it relates to share capital, In order to get that money back, you actually have to have an authorization of the board to approve the distribution of amount invested in terms of capital, and so it's a more formal process. The repayment of a shareholder loan is simple. The corporation writes the shareholder a check. Very simple.
So if you're bootstrapping a company and you loan the company some money,
you owe the money, or the business owes you the money?
Sorry, you loan the company the money. The business owes you the money.
Yes.
And the business fails.
Yes.
And the money's gone.
Yes.
Is that a write-off, or?
It can be. The rules can be complicated, and so I'd rather take that one offline. There's this concept called allowable business investment losses and certain things and criteria that need to be met in order for you to crystallize that loss personally.
Okay. And the other question was along those lines of expensing when the company can't pay you. You go ahead and expense it, and the company then is reporting losses?
Yes.
Right, okay, thanks.
Yep. Yeah. And if in the future then that corporation decides to forgive that loan, then kicks into forgiveness of loan rules, which then could subject the corporation to income, which would offset the losses that is previously recorded. Corporate structure is one of the key things that you as entrepreneurs need to think about, because the corporate structure drives the tax treatment. It determines the taxation of the business. And so, I work with a whole bunch of technology entrepreneurs. And they come up to me and they say, well, I've got an investor in the US, and he says he only wants to invest in a US company, so I'm going to incorporate my business as a US company. And that's the worst thing they could probably do. Because by doing that, they're not getting refundable shreds, which Terry will talk about. There's other incentives they've just blocked themselves out of. There are some tremendous tax advantages to being a Canadian incorporated company. Things like the taxation rates at 15.5% that we talked about on income less than $500,000. There's access to capital gains exemption. When you sell a Canadian-controlled private corporation, you as the shareholder get access to a one-time, lifetime capital gains exemption of $800,000. So any gain up to $800,000 is tax-free. If it's a non-Canadian corporation, it doesn't exist. A lot of tech companies, knowledge-based companies, grant options to key employees. The option treatment for tax is beneficial for Canadian corporations. It's not beneficial for non-Canadian corporations. And so this is here for information to make sure that you are thoughtful about the corporate structure. And so it doesn't have to be complicated. It can be simple. And oftentimes it really is just a Canadian incorporated entity. And it becomes more complicated as the business gets more complicated. And if you truly have an investor, and it's a foreign-based investor and they want to invest in a certain type of structure, well, then it's a question you have to decide as an entrepreneur, as the amount of money that they're going to give you, does it offset the benefits that you're going to lose out as a Canadian citizen, Canadian resident? Okay? Yes?
If you're selling to the U.S., let's say you're shipping from China and you're
Yes.
selling to Canada and U.S.,
Yes.
would you create a U.S. corporation, have the Canadian corporation wholly own that for tax purposes?
Yeah, so maybe I'll come back to that because I actually addressed that question. And so we'll get into that detailed question shortly. But first, let's talk about U.S. because a very common question. Because most of my clients, where are they selling? Canada is not a big market for them. They're selling into the U.S. It's the first market they go to. It's the first place they commercialize. And so oftentimes that triggers a tax compliance requirement. And we'll get into the details on when you might trigger a tax compliance requirement in the U.S. But like Canada, if you trigger a tax compliance requirement, there are going to be tax filing requirements, corporate and states. And so again, this slide here is for information. And I don't need to read it. It's just there. So you know that if your business is such that you have a permanent establishment in the U.S., you will have a U.S. tax filing requirement.
Question?
Yep.
On U.S. income, with crowdfunding now, and a lot of the crowdfunding being done through U.S. platforms and coming in as U.S. cash, what is the tax treatment for that? Is that considered income and therefore compliance?
So it's a complicated area because crowdfunding can be social contributions. It could be amounts provided in lieu of receiving a tangible goods. So we'd have to look at the fact pattern. One of my clients just ran a crowdfunding program, but it was for a product that they were selling. And so that is taxable income. The crowdfunding that they raised comes in as income when they deliver the good. So the cash comes in, it sits as non-taxable until you fulfill your obligation, and then it's taxable income. But it is a gray area because there are different types of crowdfunding, and so I think the reality is it's likely going to be taxable. It's going to be income. So just getting into a bit more detail around doing business in the U.S. So if you're selling into the U.S., if you're based in Toronto and you're selling into the U.S. and everybody's here and you're selling into the U.S., the question you have to ask yourself is, at a federal level, do you have a permanent establishment? Do your activities in the U.S. Subject you to having a permanent establishment? And just by selling into the U.S. doesn't trigger a permanent establishment. You have to physically be in the States. You have to be either have an office or have employees or have contractors. The rules are complicated. And so when you start selling into the U.S., you should have an advisor that you are sharing with the business model and how you're selling into the U.S. so they can advise you on what your tax requirements are, if any. But just by simply selling in with no physical presence in the U.S., it's unlikely you've triggered a permanent establishment federally. And then it cascades into the states. So there's 52 states. So we have our provinces, they've got their states. So the states have a tax regime separate from the federal tax regime. And they have a concept called Nexus. Nexus is the same concept as, well, it's similar to permanent establishment. It means, do you have a presence in the state? If you have a presence in the state, then you have an obligation to file a state tax return and declare income in that state. And that could be triggered by simply attending trade shows, meeting with customers in the states. So very complicated, and it varies by state. Every state has subtle differences in the rules. And so I don't want to scare you. It is complicated, but oftentimes by describing your fact pattern, if you've got the right advisor, they can give you some good pragmatic advice that'll help you make sure you're comfortable with your tax compliance requirements. Yes?
When you have, for personal, let's say, investments and so on, there's tax treaties, right? So you don't pay tax twice is the idea.
That's
It's
right.
the same thing for
Corporate, yes.
corporate income then?
Yep, that's right. Yep. There's a foreign tax credit and integration, and but there will be withholding taxes. So there are timing differences that can be problematic from a cash flow perspective, because as you know, running your businesses, cash flow is something you watch all the time. And if you have to pay someone tax and to get it later, that's not a good outcome. So you always try to avoid those kind of things. You may not be able to avoid them, but you try to.
So if the tax rate's higher, let's say in a particular state, with the state and federal combined, do you end up basically paying on those sales in that state the higher tax rate, not your Canadian tax
That's
rate?
right. Yeah. And so that's why I make this point here around the efficiency of the tax structure. Consider corporate tax rates outside of Canada and ensure that the most tax efficient structure is in place, because the tax rates are different globally. And so when you're doing business globally and you have tax compliance and you're generating income, there's some planning that you should do to think about what your global or your combined tax rate is. And often, and many times, the tax rates in Canada are more favorable, believe it or not, than elsewhere. So oftentimes the strategy is to have income stay in Canada. And you're Canadians, you're generating IP here, intellectual properties here, so that's typically the place you want it. You are also investing in your business, so you have cumulative losses. Those losses offset income, so you want the income here first, not outside. And so there's ways to plan around sort of where your income is and how it's taxed. Yep.
Question is, if you had a U.S. distributor, say Amazon.com.
Can you start again, please?
Question is, if you had a U.S. distributor, say Amazon.com, would that count as a permanent establishment?
It can. Yeah, there's some very specific rules that have just been released. So we had to deal with this issue. Online business selling natural products. They were using a distributor out of the U.S. So we had to look at the drop shipment rules and whether that triggered. It's probably outside the scope of this discussion. I think if you've got that scenario, you need to make sure that you're talking to your tax advisors and getting them to explain if that is in fact triggering Nexus. This is really just to highlight that you should be mindful of the what I call income splitting, the tax planning opportunities. And that's some of the things around dividends. We saw the beneficial treatment of dividends from a tax perspective. So do you pay yourself a bonus or a salary or a dividend? And so you should be thinking about that in terms of what the after-tax cost is, or after-tax dollars are. There's some planning, and we've been talking about the business, but the one thing you can't forget about is that there's, by virtue of starting a business, it's impacting you personally. So you need to plan how you're investing in that business. And that's this reference to holdcos and trusts. So there's some planning that you should be thinking about when you first start your business. Do you hold the shares directly? Do you incorporate a holding company that holds the shares directly? Do you create a trust? All of these things allow you to provide an opportunity income split. So a prime example, husband-wife, the husband, or let's say the wife starts the business, and it's a profitable business. And so if the wife started the business and she was a sole shareholder, took shares directly, she'd be the only one that could draw income from dividends. She could have done two things differently. One is she could have allowed her husband to subscribe for shares. Then her husband and her could have both received dividends. Or she could have invested through a holdco. The dividends could flow from the corporation to a holdco. It goes tax-free. It could sit in the holdco, no tax, other than what was paid at the corporate level. It could sit in that holdco until it's needed, and then the holdco will be owned by the husband, wife, and then that income gets split and shared between the two of them, taking advantage of the lower personal tax rates. So again, oftentimes the mistake entrepreneurs make is that no one's told them to think about how they're investing in the business and how best to structure it. And in my business, knowledge is power, and so what I always want to do is inform entrepreneurs. So again, this could be a detailed conversation, and so I'm mindful of time because I'm starting to cut into Terry's area. And so really it's don't just think about the business, but think about how you're investing in the business. And it's not a complicated discussion if you have the right advisor, because they can highlight what the options are so that you're informed and how best to structure it. Okay.
So initially, let's say you only have one shareholder. Then later on, let's say if you want your wife to go on, you can still sell shares to her, and then she can become a shareholder, right?
The problem is after you've incorporated, the business has now started to be in business. And so the presumption is that it's now more valuable than when you first subscribe for the shares. So when you subscribe for shares for a new business, there's no value. It's nominal. It's nominal. It's 6 months later. You've been in business for 6 months. There's a chance that you've created value. So when she subscribes for the shares, she actually has to pay for value. If she doesn't pay for value, then she's deemed to receive a tax benefit, and it gets taxed on the delta between. So if she paid nothing 6 months later, and the shares were really worth $1, she now has a tax benefit of $1 per share. So there's some planning you can do around that. You can do a freeze to freeze the value. So there's planning to be done. But the best and most opportune time is when the business is incorporated or before it creates value. Okay?
What is a holdco? What is a holdco?
Holdco is a separate corporate entity. So it's an incorporated business that's sole purpose is to hold the shares that you would otherwise hold personally through that corporation. And that vehicle has certain tax advantages. Tax compliance is about the day-to-day business, but it also impacts every knowledge-based business that I know is being built to be sold. And so that may not be for some, I know we've got some that are lifestyle businesses, but almost every business is being built to sell. And so if you're not up to date on your compliance requirements, you've made mistakes in terms of how you've done things, it'll come to roost the worst time ever when you're trying to sell the business, because the due diligence process will uncover all of this stuff, and it will deflate value. It'll be a very painful exercise for you. And so you have to stay on top of this stuff to maximize value and exit. And then a lot of the stuff that I talked about on holdcos and trusts all then play out to how you minimize your tax cost when you sell. Because when you sell, hopefully it's a sale at an amount in excess of what you've paid into it. And so there's going to be tax income. So how's that taxed? And you want to minimize that tax to you personally. And so the planning you can do today can help minimize that cost in the future. I'll leave this here, but the rules are complicated. But remember, if you're hiring people, you have a choice. Are they contractors or are they employees? And this slide helps you understand whether they should be contractors or employees. But remember, it's the corporation's obligation to, if they're really employees and you're treating them as contractors and CRA assesses them as employees, the corporation is on the hook for the employee portion of EI and CPP. So you want to be very careful that you're aware of these rules and that they truly are independent contractors. They're not just working for you, they're working for others. They have a history of being independent contractors. They bring their own tools. You may guide them, but they truly are independent contractors and not employees. Independent contractors should not get options, should not get employee benefits, because those are types of things that are available for employees. And that's a broad stroke sort of commentary. But again, this is here just to highlight that you're aware of those rules. And this is self-serving, but this is why you got to hire guys like me, because we know the stuff. If you hire the right advisor, they can walk you through the stuff very efficiently, so that you are informed to make the right decision. And sometimes that costs some money, and sometimes you can't afford it. But at least you know why you're not paying for it, and know why you're spending money somewhere else. So in 3 years after, if someone says, oh, you should have did that, and you don't go, oh, I didn't know that. Or, okay, I knew that, but I couldn't afford to, and that's why. And so you just live with the results. Okay, so what you really want to know is what Terry's going to tell you.
Yeah.
All right.
Yeah, so enough with the boring stuff. Thank you. Enough with the boring stuff.
Yeah.
Talk money. So there were a lot of comments as we went through the introductions about SRED. Some people have gone through it. Some people want to go through it. Some people may be in the middle somewhere. So I'll start high level here talking about government incentives, and then we'll drill down into SRED a bit. And I think I heard one comment about digital media tax credits too. We can explore that. And we've got a really interesting chart that shows if you're claiming SRED, why you should also be looking at Irap. Has everybody heard of Irap here? Yeah? Okay. So, small business, medium-sized business, large business. From my perspective in the world of government incentives, government funding, are you really maximizing what you're getting out of that government money? So are you looking at tax credits? Are you looking at grants? Are you looking at rebates? Are you, of the ones that you're looking at, are you reasonably certain how much you're getting and when you're getting it? So obviously that's going to impact your cash flow. And in many cases, especially for the small companies, it impacts your success. You're getting cash 18 months from now, probably not as valuable as having it tomorrow. Okay, so those are kind of the questions that are always in my mind when I talk about incentives. What are the available ones that make sense for your business, and the timing, and ultimately the amount of them. So there's a lot of stuff out there, right? When you look at it at a municipal level, you look at it at a university level, provincial level, federal level, there's all kinds of stuff out there that can help businesses. Some of these things, they pop up and disappear before you even realize that there was money available. But you can spend a lot of time, energy, resources scouring the universe and distracting yourself from actually doing the stuff that matters the most, which is getting your work done, building your business. There's some great resources out there, which I think we've got at the end of the slide deck, where you can go and do some quick searches. Those resources are getting better and better. But again, you got to be careful that you're not wasting too much of your precious time chasing, spending $100 to chase $10 is what I always say. Got to make sure that what you're chasing is valuable for you. There's a good match for your business. There's a good match for where you're taking your business, and that you've got a reasonable chance of success. So, as an example, back in the stimulus budget days, 2007, 2008, I guess, a lot of government money, a lot of grant programs out there, and a lot of people spent a lot of time trying to get that grant money. But it went to very select few companies Some big buckets of money went to some very few companies. And in the end, you kind of wonder, well, was that investment all for naught? From my perspective, it's important to look at the whole business. So where have you been? Where are you going? What's your strategic plan for growth? When do you need resources? When do you need R&D done? When do you need product release? When do you need to have your sales and marketing strategies and people in place? Take a holistic view of the business and then understand where government assistance can help you. Now, everybody here, we've all talked about SRED already. That is the largest incentive in Canada. And if you're doing R&D, you need to be looking at SRED. There's no question there. But it's not the only thing out there that can help you. All right? It's the biggest, the most important, but not the only thing. Okay, so when you overlay SRED and some of these other programs on your business, then you can get a better idea, well, what's the total amount of funding that I can get, or where am I going to be out of pocket for X amount of time until some of this assistance comes in? If there are programs on the horizon, when do I need to get my application in, essentially my resume, to see if I can get that funding? Or on a tax credit basis, when's my corporate year end, so I know when my tax return's due, so I know when my SRED's claim is due, so I know when approximately I can get my cash back. So all these things trickle in. Ultimately, as Bryan alluded to too, you got to think about this stuff ahead of time. When you think about it after the fact, one, it might be too late, which would be disastrous. Two, it just makes it more difficult to scrounge up the evidence, to scrounge up the information, and think back, well, what did I do the last 12 months or the last 18 months? Is there anything in there that would qualify? It might be too late by that point. Of course, stop me anytime you have a point or a question. Actually, I'm going to jump past this one to get to this one first. So I mentioned Irap. So for those who don't know Irap, is there anybody who doesn't know Irap? Okay. So Irap is a funding program through NRC, National Research Council, I guess. And they offer, it's industrial research assistance program, I think is what it is. So they offer funding, grant funding, to help companies kind of get through that R&D stage into commercialization. Now, there's a few different programs, but most often when people refer to Irap, they refer to, well, I've got a defined project that I've got Irap approval for, and Irap is going to give me, reimburse me 50% of the cost to a maximum amount. I've seen projects at 80% reimbursement, very few at 100%, but that has happened. But ultimately, there's a percentage that they reimburse up to a maximum, okay? And that percentage is generally on salaries and subcontractors. So, to an earlier point, Bryan talking about, well, do you pay yourself a salary or do you pay yourself dividends? Here's one example where if you're paying yourself dividends, you've kind of screwed yourself out of government money for Irap, for the purposes of Irap and the purposes of SRED. Okay, so it becomes a kind of a complex mechanics of the calculation. What makes sense here in terms of how to compensate myself? So what we've got here is, if we assume we've got $100,000 that we've spent on R&D, okay, so this is $100,000 of salaries. If we had a Irap fund or Irap agreement that funded 50%, well, of course, we'll get 50% or 50K back, over the period of the project. Now, there's a misconception out there. People say, well, I'm getting Irap funding for this project. Maybe there's a bit of SRED that I could claim there on the remainder, but it's not worth my time because there's not enough money out there. Well, what we're trying to show here is, well, if you got the Irap, you'd get 50K. On the 100K, if you claimed SRED only, I'll explain later why it's 68. So people would say, well, is it really worth the difference to go, or really worth my time and energy and the cost to go after the incremental amount? Well, what we're saying here is that actually it's not 1 and 1 is 2. It's much better than that. And I'll get into why spending $100K on salaries, you can get $96K back between IRAP and SRED. So one, dispel the myth that if I'm getting IRAP or if I'm claiming SRED, there's no sense going for the other one. That's incorrect. That's an incorrect fallacy. Okay, the math will show it. But two, also the importance of paying a salary in the corporation. Okay, did I lose anybody there so far? Everybody all right? It's a pretty astonishing number, actually, isn't it? So the key factor as to why this works this way is, I'm going to jump into SRED a little bit now. So when you claim SRED, for those who've gone through it already, you can claim salaries that you paid out. You can claim subcontractors that you claim or that you used, Canadian-based subcontractors. You can claim materials consumed, so things that were materials that were destroyed or needed for testing, physical things. But you can claim overhead as well. So overhead is calculated as a percentage of the salaries that you paid that are eligible for SRED. So if you had $100,000 of eligible salaries, the overhead calculation is 55% maximum. This is why it's 96, because we're using the maximums here. So you could claim not 100K of SRED, but you could claim 155K of SRED. Am I losing you, Veronica? Yeah. Okay. So just to talk about the overhead for just a second, so hopefully it clarifies. So SRED, there's two ways. You can calculate exactly what your overhead is, look at all your accounts that your bookkeeper you have set up, and figure out what is related to SRED and what is not related to SRED. You can do that approach. It's harder, takes more time. Probably 15, maybe even 20 years ago, the CRA said, okay, you could still use that approach if you want, or you could just calculate your overhead as a percentage of your salaries that you're claiming. Okay? So that's where the 55%, it used to be 65. Now, as of 2013, it's 55%. Okay? So that's why we get to add 55K to the 100K of salaries. The one caveat there is that if you don't have 55K of overhead in your company, you're going to get restricted down. So this is the best case scenario. I'll step through the math on the whiteboard afterwards, but essentially to step through it, so you've got the 155K of a SRED claim. You take away the 50 that you received from IRAP, so you've already got that in hand, and you calculate your SRED claim on the remaining 105. Okay? When you go through that calculation, it'll come out in the neighborhood of 96K.
I have a question.
Yep.
If I understand you correctly, just checking here. So if you're doing research, you could pay yourself a salary and they would reimburse you.
Yeah, I mean, so IRAP, you have to get pre-approval. You have to work with an IRAP representative to identify what the project is that you want them to consider funding, and you come to an agreement. Then you'll have an IRAP agreement that says, we will give you 50% of your salaries, expenditures, 50% of your subcontractor to X amount as a maximum. Then that's what we're referring to here as the 50K. So again, that's all got to be done ahead of time before you spend the money. Okay, and that's where the planning and the forethought comes in to say, oh, this is where I'm going. I better go talk to an IRAP guy and see whether they're interested.
Does SRED, will SRED allow you to do the same thing?
Yeah, so here's a fundamental difference between IRAP, which is a discretionary funding grant mechanism, and SRED, which is a tax legislated incentive. Okay? So SRED it's in tax legislation. As a taxpayer, you're entitled to claim SRED if you meet the criteria. I can go through the criteria in a few minutes if people want a refresher. So that's fine. You meet the criteria, you can claim it through your tax processes. Yeah, you will likely have an audit, and maybe you'll end up in a dispute whether you actually qualify or not. Could be an unfortunate situation. But ultimately, through the tax rules, you're allowed to escalate. You could object to, if they deny it, you could object to it. You could ultimately take it to court if you wanted. That's fundamentally different than Irap discretionary type programs where you have to apply, you put your best foot forward to see, are they interested in giving me funding for what I'm trying to do? Does that get at what you were asking? Okay. Okay. Any other questions before I kind of keep going here? No? Okay, so just to summarize again, if you have a chance to get Irap, go for it. It's going to help. You might not get to this 96% number, but it will be greater than what you would get just claiming Irap or just claiming SRED. Yeah?
Sorry, if you're in a young business, you're not sure you're actually going to have the funds to pay that salary, you still put forward the claim and then just withhold your salary and still get the funds, you get to scale it back. How does that work?
Well, yeah, so that's an interesting question. So the question is, if you don't have the funding up front to issue those salaries. So here, and sorry, one clarification before I get to the question. Here we're talking about salaries not to the owners. We're talking salaries to employees. If these are salaries to the owners, the math is still good, but it's a bit lower, okay? Because the reason why is there's some restrictions on SRED as an owner, how much you can claim of your salary. So that said, there are some planning opportunities where ultimately you can pay yourself a salary, lend it back to the corporation. So essentially the corporation's not out any money, but there is the issue of the remittances, the payroll remittances, right? So your EI and your income tax. Probably a bit too convoluted to get into right here, but all that to say is then you have to think about the cash flow. Okay, so you've declared a salary so that you can start to claim some Irap and some SRED. You've loaned it back to the company. You've got some remittances to pay. When are they due versus when is the Irap money coming in versus when is the SRED money coming in? So it's a very astute question, and it's some planning that we do around it. But you have to plan. You have to be ahead of the curve, because if you get stuck not having made your remittances on time, there's penalties there. It could go wrong for you and get stuck in a nasty situation, I think. Okay? So then going back to this slide, then when we talk about full entitlement, that's exactly what we're demonstrating here, in this case between Irap and SRED. But when you get your paws into these incentives, you need to understand the rules, and you need to understand what you can claim when and how these things stack together. So that if I am getting Irap and SRED and I've hired a co-op student, whether it's a co-op tax credit, maybe I've hired an intern, we've got some intern funding, how does all this stuff fit together so that I can get as much money back as you're entitled to? That's what we refer to as stacking. Okay, so this is an example of stacking, what we refer to as stacking. And then to the point brought up, the rules of discretionary incentives versus tax credits. Tax credit, there's, well, for SRED, there's a lot of legislation out there. There's a lot of guidance documents. There's some case law. There's a lot of things out there that you can go to, resources, to figure out, is this eligible or is this not eligible, or maybe it's a gray area and you have to take a position on it. Discretionary incentives, Irap is usually fairly crystal clear, but if you got into some other grants through Ontario Centres of Excellence, for example, there's a bit of leeway in terms of how you can use that money. And as long as it's within the vague rules that are defined, then you should be okay. But again, you got to know that. You have to understand what the rules are going in. Okay? Before I move here, so there was a lot of questions that came up, or points, I should say, about SRED. And it sounded like most people had claimed. Did I get that right? Has everybody claimed us? No? Okay. Oh, okay, so just kind of the opposite. So maybe before, we'll just leave this up, but I'll talk a little bit about SRED qualifications for those people. It sounded like there were some fundamental questions there. Is that, everybody good with that? Okay. So SRED, scientific research and experimental development is what that stands for. And we'll focus on experimental development, because that's generally what people are doing. Experimental development in the eyes of the Income Tax Act means that I'm trying to create a new or improved product or process, okay? And I'm doing it through what they call systematic investigation. So I'm following a scientific process to build that new product or improve an existing product. What that's getting at in those tax words is that I've got in my industry, there's a base level of knowledge that I'm expected to know. So whether it's computer science or mechanical engineering, agriculture, there's a base level of technology and knowledge out there. What SRED is, it's about going a little bit beyond that base level. So you have to be attempting. You don't have to be successful, but you have to be attempting to overcome scientific or technological obstacles. Let's say, I'm in this industry, I know what I'm doing, the people who work with me know what they're doing, but this is a fundamental problem that we're not sure how to solve. Or maybe we've got some ideas how we're going to solve it, but really the outcome of that resolution is uncertain at best. Okay, that's what SRED is about. It's about trying to achieve an advancement in technology. You're following some principles of science. If I'm a software guy, I know generally open source tools that are available to me. I can go to forums and see what people are talking about. But if I'm stuck with a problem that generally people don't know how to solve, chances are I'm doing SRED. Okay? That's really where you need to stop and think, okay, or realize that maybe I've got an SRED claim going. So the key criteria, technological obstacle or scientific obstacle, you need to be encountering that. The technological advancement then is, well, what have you achieved to resolve that obstacle? What's the advancement in knowledge or the advancement in technology that you've attempted? And then the third criteria, technical content, means that you, your team, you're qualified people to solve that problem, and you've followed a methodology to get there. So it's not just kind of, did that work, did that work? You actually understand the problem, you work through methodology, and, I'm not sure if I have it in the previous slide, you've got some evidence to support it. Who was it that went through an audit recently? Yeah, that was you. Went through an SRED audit? Oh, that was over here? So how much emphasis did they put on evidence and documentation? Oh, sorry. Yeah. Thanks, Bryan.
It was interesting, actually. So we took the box that we were doing technical development, and it didn't seem like they wanted a lot of evidence. Like, we didn't know how much we were supposed to bring, but we knew pediatrics development. And so once they came in thinking they were going to give us nothing, and
end of the time, we actually got more than we claimed. And basically, we had all of the evidence that we had was a lot of research papers that we've been producing on the product.
Okay. So it was papers that you produced, or your team?
Yeah, or that our clients have produced. So,
okay.
And then the other thing they asked a little bit about bookkeeping, like how many hours and stuff like that. But they only asked for like a 1-month segment of just one of our employees.
Okay.
So there wasn't very much.
So that's a great outcome. What we are seeing, and it's not meant to scare anybody, but we are seeing a much heavier emphasis on evidence and supporting documentation. Now, I think we've got a lot of different industries and markets represented here, so it's not a one-size-fits-all type of thing. But ultimately, when you think that you're going to do SRED, or you know you're going to do SRED, it's best to start the evidence generation at that point. Not trying to look back 12 months and see what you created or see what you could create that would justify the work. It's better to do it starting day one. Okay, so this can be formal documentation. It can be, I don't know, design specs, testing documents. In my opinion, it's best, even whether it's in a business plan or somewhere, where you identify, well, these are the things I know and these are the things I don't know. Again, from a science or technology perspective. Getting that down on paper and having it, kind of time-stamped, that's a great piece of evidence. Informally, email threads and discussions, or maybe whiteboard discussions, or taking pictures of whiteboards after you're done a meeting. Those can be forms of informal evidence too that help support the idea that, hey, we didn't really know how to solve this problem, and we had to work through many discussions with knowledgeable people, what have you, to find the resolution. Yeah?
So, can you claim it, let's say you've done the discovery, like you've done the scientific breakthrough, and now let's say you want to patent it, and you have to pay employees, let's say, to do the patent. Can you claim it for that?
You cannot claim patent time. So all the time that those employees spent getting to the breakthrough, that would be all eligible time. But the time spent actually writing up the patent is, it's very explicit that that time is not eligible. Nor would it be a cost to pay an IP law firm to do the patent filing. That would not be an eligible cost either.
So it's not contracted, just
Yeah, either way. Yeah, it's very explicit.
Even if there's
Yeah.
still research going on, like the patent's not fully won?
Yeah, but you have to carve out the research time from the patent writing time. So let me elaborate there a bit. So if you have a researcher, and from the past he's been, it's clear he or she is doing SRED, now you carve out a bit of their time for writing a patent. So what SRED allows, this is across the Income Tax Act in many different places, but there's a concept of all or substantially all, okay? Which means 90% or more. So if an individual is doing SRED 90% or more of their time, you claim them at 100%. So if that patent writing time, for example, is still 5% of their time, then it's irrelevant. If the patent writing time is 25% of their time, then you have to look at, okay, well, I got to take away the 25%, I'm left with 75% of their time. Make sense? Okay.
How about the project management time?
Yeah, that's an interesting one. So you get into project management, and I'll lump in product management in with it as well. So you have to look at what time, let me stop myself. So the words in the Income Tax Act are directly engaged. You can claim labor that's directly engaged in trying to overcome those obstacles, reach those advancements. So from a project management perspective, Yeah, I mean, that person could be helping specifically track the issues that are going on, making sure that person A and person B are conversing, they're working on it. That kind of time would be eligible. Where project management would not be eligible would be, I don't know, the customer delivery is December 2014. Are we on track for that customer delivery? I got to make sure that there's equipment that needs to get delivered to that customer on time. That kind of stuff, no, not eligible. And similarly with product management, what you'll see is maybe a very highly technical person that gets involved with the customer to understand the needs and the requirements and so on. And then it's their job to translate that back into the R&D team and say, this is what you guys need to build. And this, from my perspective, these are the technical requirements. That kind of time could be eligible. This time over here would not be eligible. Yeah.
So I guess one of the things I was curious about is, let's say you were, you need sales to, you need new customers or new users. So we do like medical software, we're trying to get new users. Whether or not sales can be put into that, because without the users, you're not, and you're altering a process, and we're doing pediatrics. So whether or not, and we want to try something new, but we actually need to have people use it. Does sales get lumped into that? Because without them, the product, like we're not building a technical product, we're doing like a pediatric development. How can you, I guess, like does sales get put into that? And then how would you, I guess, put the evidence behind that?
Yeah. That'd be a tough sell. Sales, tough sell. Really, back to the term directly engaged, you'd need to show that a salesperson's time is directly related, technically related, to overcoming the obstacles that the CRA has agreed are eligible.
So for the obstacles were like pediatrics, like what your customers were doing. Like that's
Has to be a scientific obstacle, though.
Yeah, but it would, within that, it's still like, well, wouldn't it be, what's the other, you said, experimental development? Like, it's still an experimentation of, like, this is a new product, how that rolls out, and it has some, it would push forward, like, pediatrics.
Yeah, I don't think it would fly, to be really honest. It'd be more about user acquisition, I think, the sales team, rather than, which I understand is important to show that it's going to work. So it's a critical corporate business activity, but I don't think the CRA would agree that it's directly engaged in the science of what you're trying to do.
Okay, yeah, so in that way, you're saying that there's a set, like, if your user is the one that like is testing, let's say you're not doing it internally, it actually involves other people. Like, I guess I'm just really curious about, like, a lot of technology involves someone else. We're not doing a patent, we're not doing that sort of thing. We need other people to use it. We're not doing it all internally testing. And our users are our testers within this that are involved in this scientific development. Like,
are you paying the users?
No.
Okay, so but you're talking about the cost of acquiring those users,
yeah,
whether that's an eligible cost.
Exactly.
I'll think my initial reaction is no, that it wouldn't be, but I'll think on it a bit more. Maybe we can swap emails after something. Yeah. Yeah.
So you have a piece of research that you do, say in software development. Can this thing be done with software, and you figure out, you do your research and it can, and then you build a product around it, say a website. Is the productization eligible?
Generally, no, because again, you got to relate it back to those technological obstacles that you've overcome or you're in the process of overcoming. So, for example, if it's shrink wrap software, I don't even know if that exists anymore. But up until that point, you would have done all your R&D, your experimental development to get your software ready, and then kind of comparing it. right? Well, once putting it on a CD and wrapping it up, that's a commercialization process that has nothing to do with, and I'm kind of visualizing putting a website around to be able to distribute your software isn't really related to what's the actual software.
Yeah, not necessarily to distribute the software. Say you have a concept that maybe computer software could read minds, and you develop the software and get it working.
You're not reading my mind right now, are you?
Create a website that sells that product and delivers the product.
Yeah.
You know, the whole infrastructure, all of that is.
Oh, so I mean, it's delivered online. Are you right? I'm not going to the website to purchase the software.
No, you're
for
actually
download.
using it online.
Yeah. I mean, I wouldn't say the whole aspect of it because I'm assuming, maybe incorrectly, but I'm assuming there's going to be a lot of UX stuff that you're going to do with the website.
Exactly right. You can't just use the core research piece. Right.
So it'd be a pretty subjective cutoff. I mean, how much of the website did you need to do to show that you had resolved all your obstacles? Right. It might be a tough sell to say I needed 100% of everything.
Okay. All right.
But certainly, you would have needed some semblance to see if I can deliver this online. Yeah.
Thank you.
Sorry, just to give you a time check, we have about 5 minutes.
5 minutes. Brian. Yeah, that's right. Okay, a couple of other points that I'd written down from the introductions, just to cover these off. So we've covered. Oh, so one aspect is I don't think everybody is incorporated here, but just to flash back to, incorporate or not incorporate. As an individual, you can still claim SRED. However, what you get as a tax credit, it's now 15% as an individual, and it's non-refundable. So what that means is you get 15% of what the expenditures are as a tax credit that goes against taxes that you owe. So if you don't owe any taxes, then that tax credit, you can carry it forward 20 years or you can carry it back 3 years to recover taxes. But it's non-refundable. As Bryan mentioned, the CCPC, the Canadian Controlled Private Corporation, if you claim SRED in that case, federally, you get a 35% fully refundable credit, so that's cash back. Doesn't matter your corporate or your taxable status. And kind of on top of that, there's an Ontario 10%. Excuse me, 10% credit. So the 35 and the 10 don't add up to 45. That would be too easy. The 10% grinds the 35. It comes out to effectively about 41.5% between the two credits on a corporation. Okay, so that, again, just one thing I wanted to bring up because there were a lot of people asking about SRED, and I think incorporated versus unincorporated is an important distinction. Again, getting back to here, right? If you're a corporation, you've got Irap, you've got 100K in salaries. We'd have to look at the overhead, but that picture looks pretty good at getting that money back. Okay, and then somebody was also asking about, I think, talking about percentages that they're paying their provider. Not sure if I heard 30% was a number, but I mean, there are a number of ways that you can pay to have assistance for SRED or any incentive, really. And paying on a percentage basis is always more expensive than paying on, say, a fixed basis. But you get to pay later. And on a fixed basis, you usually have to pay ahead. So you have a question here, I think. I guess I'll zip through that real quick too. But, so percentages, I mean, 20 to 30% is a very popular number in the market on a percentage basis. But I would caution you as to, is that really the right thing for the business? I mean, you have to think of the risk. Is the claim risky or is it not risky? Do you have enough cash flow up front to pay a lower price? because you're definitely going to be paying a lot more on a percentage basis overall, because you're having to pay that firm to compensate for risk and timing of delay of payment. I'll go quickly through the digital media credit. So just to compare, contrast it with SRED. SRED is all about science and technology. The Ontario Interactive Digital Media Credit is Ontario specific, and it's all about, have you created an interactive product that informs, educates, or entertains users? Okay, so a gaming company, educational software company, a media company, all kinds of websites that are providing mostly about information and not primarily about promoting products and services. Okay, that's a very important distinction. You can see a website that has some promotion on it, but if it's primarily about providing information or education or entertainment, it could still be eligible. Okay. It's a 40% fully refundable credit. So again, it's cash back. It's based on salaries and subcontractors in Ontario. Again, because it's an Ontario credit. And there's a very important point. We've run into this a number of times where it's an issue. 90% or more of the product has to be created by the qualifying corporation. So the corporation that's applying for the credit has to have had developed 90% or more. And what we see often is because of, trying to manage your business, you hire subcontractors to do work. And all of a sudden, the subcontractors that you're managing, they're half the work. And now you've knocked yourself out for the digital media credit.
So salaries only, are you saying?
No, you can claim subcontractors, but the amount, it's not necessarily a mathematical thing. It's more of a holistic thing of created this product and how much did the company do versus how much did subcontractors do. But that proportion cannot be more than 10% subcontractors contributing to the product.
Have you ever talked to MaRS about, SRED has started this entire financing industry where you finance your SRED claims, the Espressos of the world, R&D Capital Montreal.
Yeah.
The paperwork to do that is ridiculous. The interest rates are ridiculous on that financing. Have you ever spoken to MaRS about taking on that business? Making it simpler for us to finance our SRED, because it takes a long time to get, to simplify the paperwork and get us some interest rates that make sense in the marketplace?
No, I haven't had those conversations. I know the companies that you're referring to. Yeah, it'd be an interesting conversation. It's an interesting point.
I think that would be a tremendous service. What we went through. Just as a veteran of 2 SRED audits, I would say to you up front, know the vocabulary of your SRED claim.
Yeah, that's a great point.
And put your vocabulary in the invoices that the subcontractors send you and in your job descriptions of your employees, because that will save you a lot of time and hassles.
So it's a great lesson learned, right? And if you'd known that 2 years ago to kind of do it up front.
You wouldn't have to do invoices over again.
Yeah, that's right. Or endure however many hours of audits, right?
Yeah, you will have to defend, so know it up front.
Yeah, that's a great point.
We are out of time, unfortunately. Can you do a 1-minute wrap-up? I'm assuming you and Bryan will have contact information available for the participants.
Yeah, I think, let me just advance here. Some resources here. I think you guys will have access to these slides, but some resources you can look at. And, from my perspective, plan ahead. You got to know what you're looking at for government money. Plan ahead for it, because you will get the audits, you will get the reviews, you will have to provide evidence, supporting documentation. Hopefully it all goes well, but you're dealing with revenue authorities. Sometimes it just doesn't go well through no fault of your own or whatever provider you use. It's just the bad luck of the draw sometimes. Bryan, is there anything you want to?
No,
summarize?
no, we're accessible. So I think one of the slides here has our contact information. So happy to follow up with anybody if there's further questions. And we do have the sessions that Gina talked about. We'll stick around for 5 more minutes, and then we've got to go. But
Yep.
hope it was helpful.
Good. Thanks, everybody.
Thank you, everyone.